everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the language of technical analysis. The technical toolkit is designed to help us identify trends, follow those trends, and anticipate when those trends are reversed or reversing or set to reverse. There are times, and I will tell you in my experience in the industry, there are times when I feel like all of my peers in the industry are all collectively kind of seeing the same information. We're kind of all leaning the same way, and it feels like as a group, we kind of have a good sense of things. This is not one of those times. People that I have followed and respected and have talked with for years and years are on completely different sides of the coin here. I feel like from a technical perspective, depending on what you look at, you could justify a fairly constructive argument here going into this weekend, going into the next couple weeks. On the other side, you could paint a pretty negative picture. When you think about the macro headwinds, think about how elevated a lot of the breadth conditions have been and the likelihood that we pull back. We'll try to sort through those and see what conclusions we can draw together. We have a great guest today, Tony Dwyer. I'm always excited to talk to Tony, pick his brain a little bit about what he is seeing and hearing. Next week, three great guests for you. On Tuesday, the 30th, Joe Rabel from Rabel Stock Research. On Wednesday, the 31st, Mish Schneider from Market Gauge. And then on Thursday, September 1st, we have Mike Shell from Shell Capital Management joining us on the show for the first time. Also, just so you know, we have a kind of a small but very incredibly important event coming up October 7th and 8th called ChartCon. We last did our virtual conference 4 years ago, pre-pandemic. We are dusting off the ChartCon name and coming at you with a fantastic virtual conference. Today's guest, Tony Dwyer, will be part of that event on a panel of fellow pilots who are also strategists. Jeff DeGraff from RunMac is going to share some experiences as well about how he's applied lessons in the air to lessons analyzing the markets. We have a great group of other contributors as well, including Larry Williams and Linda Raschke, both giving keynote addresses. That's a two-day event, October 7th and 8th. For all the information and to sign up today, go to stockcharts.com/chartcon. Let's continue on today's event, today's show with our market recap. Let's take a step back, look at what's happened today, but really focus on how the picture has evolved. And I will tell you, we are sort of in the no man's land, right? We're between two moving averages. And if you categorize charts generally by what's above two upward sloping moving averages, what's below two downward sloping moving averages, you have everything else in the middle. And that's what most things are in, right? They're between the 50 and 200-day, kind of like the S&P and the NASDAQ. Let's look at the market update and see exactly what happened. The S&P accelerating to the upside. The last hour really pushed the market higher to the 4,200 level for the S&P. That's up about 1.4% from yesterday's close. The NASDAQ 100 up almost 2%. So nice follow through for some of the growth areas of the market that have been struggling here in the last week as the S&P, the NASDAQ pulling back from the 200-day moving average. The VIX pulling back again. Now, the VIX had bottomed out around 20. And one of the key pieces of information we talked about last week was when the VIX reaches 20, that has tended to be a meaningful top for the S&P 500 in 2022. So far, we've had a decent pullback. The question is this resetting for the next move higher? The volatility is coming off a little bit. We'll look at high yield spreads here in a little bit later as well, if we have time, and look at the relationship of those different signals as well. Interest rates pulling back a bit today with the 10-year yield coming down to around 303. Long bond yield still above 320 at about 323. And the dollar index, not too much difference from yesterday. I was doing an interview earlier today with Forex Analytics, their pre-market interview show called the Face Session. And we had a great discussion about the dollar, about commodities, and really the strength in the dollar, a big part of the story in 2022, very much alleviated up until about a week ago. And as stocks have pulled back, the dollar index really testing its 52-week high again this week. Commodity space overall mixed. You see gold and silver up a little bit, energy prices down a bit, although energy was up on the day along with all the other 10 S&P sectors today. Cryptocurrencies all green today with Bitcoin up about 1%, Ethereum up 3%. That's getting it back above the 1,700 level. Let's focus a bit on the chart of the S&P 500 because I think we're at a pivotal time here. And I feel sometimes I probably say that too often, but this is really true. And the reason is because there are some times when we're making new highs and it's all about tracking the lows, right? It's all about sort of drawing a trend line off of the lows and just seeing if we can remain above there. There are other times, like much of 2022, where the market's in a consistent downtrend, and you're just looking for signs that that trend is reversing. Now we're kind of in the middle, right? With the 200-day moving averages above us around 43.10, the 50-day moving average below us around 39.90. We have Fibonacci levels to pay attention to all around us. If you take the framework of the January high, which is just above 4,800, the June low, which is just above 36.30, then we start to look at retracement levels between there. And I apologize, when the market gets noisier, my charts get busier. So that is its own indicator, I feel like, on the complexity of where we're at. But if you look at that range, right, from the January high to the June low, 38.2% of the way up is right at the bottom of this red shaded area. It's just below 4,100, it's around 40.88. And then the 61.8% level is just above current levels, around 43.70. We are between those two extremes, right? And so very simply, what's next for stocks? Well, I'll tell you what I think is most likely next. I'll tell you about the likelihood of retesting the lows versus the likelihood of the S&P going up to 5,000 or retesting the all-time highs. But I will tell you, in the interim, the great thing is charts will provide a confirmation. They'll provide a signal that that thesis is actually playing out. And I think if there's an easy part of the situation we find ourselves in, it's we're between two key levels. One of two things is going to happen. We're either going to break above 4,400, which would take us above the 200-day and above that last Fibonacci resistance level. And if that happens, I think the likelihood of us pushing much, much further is very, very high. On the other hand, we break below the 38.2% level. That would take us below around 40.75, we'll call it. Then you have a strong likelihood of, filling out and backing and filling more of this range we've been in for the last 3 months. That could be a retest of the lows in the 38,900 level, if not deeper, of course, right? But that the first thing that has to happen is we have to break through that support level. So I think it's important in an environment like this to set some lines in the sand. At what point, regardless of what you think may happen or should happen, what are you going to see that's going to confirm to you what actually is happening? That's where I feel like technical analysis can give you a real opportunity to manage risk and make sure that you scale in and out of positions effectively. Those are the levels that I'm paying attention to looking at the chart of the S&P. Let's go back to the sectors very quickly to finish off our market recap. Materials really getting it done here, and we highlighted one of the materials names. Mosaic, I want to say yesterday, MOS, with a nice break to the upside. The materials sector number one, up over 2%. Communication services and technology, second and third. Financials, fourth from the top, which is an interesting one. When I was scanning for new highs and lows for my premium members at Market Misbehavior earlier today, found a number of stocks in the financial sector. Kind of surprised me a little bit. Some of the constructive rotations that you're seeing there. Of course, the big question, I think, for a lot of those names, the banks and others, it's about interest rates. So we'll maybe talk to today's guests about the interest rate environment and where we should be looking going forward. The defensive stuff at the bottom of the list with consumer staples and then utilities, the two sectors at the bottom of the list for today. Just to finish off very briefly, I wanted to hit a couple charts. When I think about my overall perspective on this market, I've generally been fairly negative at times because I've seen evidence of further deterioration. I think right now we're at a big question mark moment. I think we'll learn a lot here over the next week in terms of which side really takes control. Bulls have really driven prices to where they're at now. My question is the sustainability of further gains above where we're at. This is one of the charts we've looked at in the last couple of weeks. This is a type of breadth using point and figure charts called a Bullish percent index. Out of the 100 stocks in the NASDAQ 100, how many of them are in a bullish point and figure pattern versus in a bearish point and figure pattern? Right now, it's literally 50-50, which means half of the NASDAQ 100 are bullish, half of the NASDAQ 100 are bearish, again, using point and figure charts. This is all a methodology of tracking trends upwards and downwards. These pink shaded areas represent for the last year or so, every time we've gone above 70% and then come back out of that 70% region. In 2022, it's now happened 4 times: in mid-February, in early April, in early June, and then about a week ago here in mid to late August. The other 3 times, as you can see from the evidence, we rotated lower. Now, not end of the world lower, in some cases just down for another week or two, but overall indicating a further downward deterioration. What you should look for is this indicator getting back above 70% and staying there. That was one of the key parts of this rally in July and August. We get back above there. I think the bullish case for stocks has some weight behind it in the form of positive breadth from the growth area of the market. We need to take a quick break. We'll get back with today's guest, Tony Dwyer. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's a pleasure to have you join us every weekday after the close for our show. A couple quick announcements before we get today's guest, Tony Dwyer, on the show. First off, we welcome your questions. We have a mailbag segment coming up on tomorrow's show on Friday, and we'd love to feature one of your questions on the air. Nothing is out of bounds. We were happy to answer questions about market dynamics, investor sentiment, psychology, the technical toolkit, and the StockCharts platform, anything in between. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. And we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. We are so fortunate to have knowledgeable expert guests like Tony Dwyer, like Mish Schneider, like Larry Williams, and so many more. And it's all available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Tony Dwyer. Tony's been a frequent guest on the show. He's the chief market strategist at Canaccord Genuity, coming to us from the New York area. Tony, great to see you. Welcome back.
Always great to be with you, David. Thanks for having me, buddy.
It's a pleasure, Tony. So we obviously have a pretty big event coming up tomorrow with Powell's press conference. A lot of attention to the macro environment and how investors should be sort of anticipating and digesting this. Talk to us about where your head is at. We're starting with your chart, looking at recessions here, right?
Yeah, Dave. So it's kind of funny. Everybody on the planet's looking forward to what Jerome Powell's going to say tomorrow. What's interesting is if you go back a year ago, he was talking about the 5 reasons on his dashboard that he believed that the Fed saw inflation as transitory. So, we're looking forward to finding a guide from the person that didn't, I'm pretty good at being wrong, but I think that's kind of interesting. So what you have here is the history of the market. Our friends at Ned Davis provided this chart where that vertical line down 18% from peak shows you every time that the S&P 500 since 1927 was down 18% from peak. And then what happened after that? And what you could see from our line of where we roughly are here, that's right around where we are. So we got this huge summer, as you know, I was looking for a summer rally. When you have that kind of sentiment and pessimism we did around the low, Dave, I mean, the University of Michigan Consumer Sentiment Index in the history of the data series, with all the wars and all the things, has never been as negative as it was in June.
Oh,
that sets in the history. So that sets the stage for a summer rally, which is what we're looking for. It went up more than I thought, but it was pretty powerful. Now we're at a point where you got to determine, are you going to test the low or are you going to continue to rally? And this chart should help us because what it says is that black line is what happens after an 18% drop and a bounce back. What happens if you're in a non-recession environment? You keep going up after kind of a pullback like we've had in the 4% you mentioned earlier from the peak earlier last week. Now, if you go back and test the low, it depends on recession. So if you go to the next slide, this is where I think, our old friend Marty Zweig, I know you knew Marty, Dave. He used to have these 2 statements that as a young kid I learned in the business: don't fight the Fed and don't fight the tape.
Yep.
Right now, the momentum indicators are screaming at you to buy the tape. They're screaming at you to buy the tape. But the Fed is screaming at you to not buy the tape. So you're in this fight, and I'm not really willing to make the fight because the momentum indicators are good, but you have charts like this where it shows you real liquidity. This is money supply growth plus equity bond mutual fund and ETF growth against industrial production growth. And in English, what this means is money that you, me, a company has readily available. Like you don't have to go to the market to find it. You don't have to have a quarterly distribution to get it. You can get it tomorrow. And versus what is being used for economic output. And in the history of the country, you've never seen the kind of liquidity surge we had coming out of 2020, which is why we were bullish. And then you've had that pullback, which, by the way, just as an aside, you got to be careful of getting too negative here, not just me or you. Those kind of extremes don't happen at market peaks, right? They happen closer to market lows, just like University of Michigan. Next chart, please. But what do we have in front of us? How do you know of a yield curves or of a recession's coming? As you know, everybody has a favorite yield curve. Is it the 210? Is it the 3-month, 1 year, 5 year? Is it blah, 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 5 year, 30 year? So if you look at all the possible yield curves between 3 months and 30 years, again, our friends at Davis qualified. If you have 55% of them that get to get to inversion, each time it has led to a recession. Not necessarily in the next 15 minutes, but ultimately you do go into a recession. We hit 55%. Now it looks like I'm data mining there. That 55% was outlined before it hit 55%. So I didn't pick it just because it hit it. So when that's happened, you've gone into a recession. So the momentum of the market, the oversold, the pullback we've had, given that strong intermediate term momentum, clearly we're bouncing today. It's given a little bit of oomph to the tape. I'm having a hard time chasing it sustainably because of that chart of what happens, and again, it doesn't mean you break the low and crash and go down 50%. I'd rather buy it as it pulls back, like the 4% recently, rather than chase it as it's spiking higher.
So we only have about a minute left, Tony. This has been really, really valuable. One chart I'd love for you to take a look at and just comment if you could is a chart of the 10-year yield, right? So when you think about interest rates and just leadership in 2022, first half of the year, 10-year yield going much, much higher, value vastly outperforming growth, obviously energy a big part of that. Then June, July comes through and we have a complete change. We have rates coming back down. We have growth stocks starting to reemerge. When you're looking at the 10-year, do you have a general sense of where are we at? Have we peaked out for the year? Do you feel like there's more upside, or how would you generally look at this chart?
I mean, that looks to me like a potential head and shoulders top. I mean, guys like you train me on that. I don't know if it is or isn't. It's in no man's land, like you said about other things. To me, it's all going to depend upon where inflation expectations are. The more hawkish the Fed is going to sound, the lower the bond yield's going to go. See, that's the thing that most people don't realize, Dave. The more hawkish and tight the Fed is, the lower long-term interest rates should go, because they're a reflection of long-term inflation expectations. If the Fed is keeping money supply and liquidity tight, why would inflation expectations over 10 years go up? So why would the 10-year go up? It really comes down to that.
A lot to think about, Tony, but as always, you simplify what is a complex and powerful toolkit into a very straightforward argument. And I really appreciate you coming on the show. Be safe, fly well, and I'll talk to you soon, all right?
Always a pleasure, buddy. Have a great day.
That's Tony Dwyer. Tony's the chief market strategist at Canaccord Genuity, also the editor of Dwyer Strategy, which does a great job. He really is one of my favorite strategists to make sense. I love asking Tony relatively complex things, and he has a way of just making it very straightforward and accessible. So if you really struggle to make sense of some of those terms and how the Fed and money supply really impacts your portfolio, Tony's one of the best to help you navigate that. Great take there from Tony Dwyer at Canaccord Genuity. Let's continue on today's show with our next segment, Getting Sentimental. Thursday is a great day to check in on sentiment data, because it usually updates Wednesday and Thursday. So it gives us a chance to take a step back and reflect on this component of the macro toolkit. And the way I would describe the macro technical toolkit, I think of it in three parts. It's price, breadth, and sentiment. Price tells you what the assets are actually doing, right? Or what can price tell you about the interplay between fear and greed, between buyers and sellers? Then we have breadth, which is a way of going a level below the major averages and think about the individual companies, the sectors, the groups, the themes that comprise those benchmarks and what they can tell us about market behavior. And then the third piece, which is an important one, is sentiment. And sentiment in a lot of ways is about contrary opinion. People tend to get really excited when the market's going up and really panicked when the market's going down. And by analyzing survey data, positioning data, we can start to track when we may be at one of those extremes. We'll start with a chart of the VIX, and the VIX is a good place to start, in my opinion, because it's been a great illustration of the environment in 2022 so far. We're looking here at the last couple of years. And this is the way I like to look at it, because it shows you how elevated volatility was in the first half of 2020, then how we settled into a regime, a volatility regime that's still fairly elevated, right? In 2022, the entire range of the VIX comes much further down, and that's sort of a low volatility regime. 2022 really started in November, December of last year. We've settled into a new kind of paradigm for volatility. The low end is around 20, the upper end around 30, 35. So what does this mean? Well, generally speaking, right, if you look back at the last 8 or 9 months, pretty straightforward. You sell when the VIX hits 20, you buy when the VIX hits 30 or 35. And overall, you've played this market almost perfectly so far in terms of identifying the peaks and valleys in the price. This is important because over the last couple of weeks, we have gotten back down to 20. We were above 30 there in mid-June at the market low. And my guest today, Tony Dwyer, talked about bombed out sentiment. Same thing, volatility spiking higher, similar to previous market bottoms. All of that lined up for a high probability of a rally in June. It looks very straightforward now, looking back a couple months later. What's happened now, though, we've gone to the other side of the coin, right? We were at 5% of the S&P above their 50-day moving average. That got up to 80, 90%, right? The VIX went from over 30 to now down to 20 yet again, and now we're bouncing off of there. So I think the bull case for stocks involves the VIX getting low and remaining low. And we saw a bit of a turn lower here today as the S&P, the NASDAQ bouncing higher. I think going into this weekend, this is an important chart to watch, right? The bull case for stocks, I think, involves the VIX getting below 20 and staying there. The bear case means that we've seen the low for the VIX here, at least for a short while, and we start to see elevated volatility. Important chart to watch relative to other index charts you might be following. In terms of the survey data that we track, we have the AAII survey, what we'll go to next. This is a weekly survey of individual investors. Are you bullish, bearish, or neutral on stocks for the next 6 months? A group of individual investors answer that survey every week. And I think while it is imperfect in many ways, as any survey will be, the fact that you have such a long data set is what's so interesting, because you can look back at previous market tops, previous market bottoms, and see where the surveys ended up, and then compare where we're at now to those previous levels. What was very interesting here going into June was how negative the sentiment was. 60% bears, which is actually the lowest level you saw for years, even going back beyond the last 5 years. Now, in the last couple of weeks, we've been relatively low, and bulls and bears have almost been net flat, right? Close to zero. And this bottom series is showing the spread, bulls minus bears every week. Today, you can see it's widening back out. This drop that we saw, the pullback in the S&P going into this week, has caused a drop in bullish sentiment from over 30% to just below around 28%. In terms of bears, increasing to over 42%. That puts a spread of around 15%. It's really kind of the middle of where we've been during bear market phases, to be honest with you, or pullback phases going back for the last couple of years. So is it at an extreme? Absolutely not. And you can see that as the market rotates lower, you most likely see a period of a much deeper bearish sentiment, or an expansion in bearish sentiment, which we have not certainly done yet. In terms of the name exposure index, I often talk about the anecdotal, money on the sidelines, right? The cash on the sidelines ready to be redeployed. And a lot of times when the market's had a move, the question is there enough money left in the sidelines to reallocate into stocks? Now, that's, again, sort of implied by a lot of the data. There's no great actual way to track that, to be honest with you, I think, with individual portfolios. But one of the great surveys we can look at is the name exposure index. This is a survey of active money managers and what's your allocation to equities. Now, the average response on the survey going through bull and bear cycles, around 70 to 80%. That's about, if you think about the 60-40 split for stocks, a little above that. That's about right in terms of where I would expect, in general, money managers to be positioned. You can see that even with the rally that we saw, we got up right to around 70% and pulled back a little bit, which means on this pullback, we're still below average. It's not like everyone's all in and there's been this big run and kind of everyone's all bulled up. This positioning data is actually telling you, the survey data is telling you we're not there yet. It's actually not super bullish positioning. Same thing with the Ridex flows, which shows within the Ridex family of funds, are people rotating to the more offensive or defensive portions of their of the fund family. You can see that it's actually elevated still a little bit, and this is plotted inversely because it tracks the movements in the market. Look at how bullishly positioned investors were in the third, fourth quarter of 2021. Pretty low level and really high on this chart. The histogram very close to the zero level. Look at how far we came off of that as the market sold off. And we really have made it only halfway back to that really bullish positioning we saw at the end of last year. So the way I would describe that chart, to be honest with you, is it tells you that there could be more upside to be had. I mean, the proverbial cash on the sidelines is there, according to that chart, are those two metrics looking at positioning data and survey data of active money managers. We need to wrap the show, folks, and go to the 3 and 3. These shows are so much fun to do, and I really appreciate you joining us every weekday for it. But we have to go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. My S&P chart has gotten noisier and noisier, and that on its own is probably a good indicator because I think of charts not as a painting that you don't want to touch, but it's a living, breathing document, right? It's your interplay between you and other investors. It is your ongoing conversation or your ongoing debate with the S&P itself. That's how I think of my daily chart of the S&P, which is featured on my Mindful Investor Live chart list. I cleaned it up a great deal just to simplify and show you how I'm thinking of this market right now. When I go on other media outlets, I am asked to take aggressive position, and you always want to have some big upside or downside target. Giving you a clear view of what to expect now, though, I think neutral is a pretty good place to be, because I think we've had the run. We've had the sell-off going into June. We've had a good rally, a significant rally, to the point that we could top out here, and I think that would make sense as a decent, legitimate, well-deserved rally off of extreme negative sentiment. So I would not be surprised if we break above 4,600. I will also not be surprised if we break below 3,900 and retest the lows. I will be surprised by neither one of those, because I think there's opportunity for that. But one of the great things about the technical toolkit is to define some guardrails, right? To define some levels at which you will acknowledge that one of those theses has played out. For me, these shaded areas represents those levels that I'm looking at. On the upside, we have the Fibonacci level around 4,370. That would get us above the August high and above the 200-day moving average. That would indicate a strong likelihood of 4,600 plus. The red shaded area is more of the bearish take, right? We break below 4,060. That would take us below this this Fibonacci level, a 38.2% retracement of this little run we've had higher. It would take us below a key Fibonacci level around 4,090, and that would indicate, in my opinion, a strong likelihood of testing the lows. What are your levels as you were looking at your chart of the S&P 500? Chart number 2, by the way, is new Dow theory. This is looking at two key benchmarks, the S&P and the NASDAQ composite, the S&P representing the old economy, the NASDAQ composite representing the new economy. That is a broad generalization, but that's the general sense of it. One of the great signals we got in mid-August was both of these confirming a close above the June high close, right? That's the S&P getting above around 4,200. That's the NASDAQ composite getting above 12,250. The S&P has now dipped below this week that June closing high. The NASDAQ has not. The risk to that bull thesis is these fail to hold those breakout levels. That's true for individual stocks, and I think true for this Dow theory as well. So I am keenly looking at what happens with the S&P around that level. Can we remain above that level, in which case, and the NASDAQ as well, I think the market remains fairly constructive. Finally, had fun talking with Tony Dwyer today. He's always has some great charts and some great thoughts to share to simplify what we're seeing. High yield spreads dropping as risk is doing this on the chart at the top. The sentiment is coming down. The volatility is coming down, which means that's going higher. But in the last week, all three of these rotating lower. Does that continue? That's why that's a chart to pay attention to as well. Folks, that's a wrap for our show. I want to thank Tony Dwyer from Canaccord, Genuity, and Dwyer Strategy joining us from New Jersey. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.